Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So one of my goals for 2021 was to start a podcast. It's something that I've been thinking about doing it for a little while, so I sort of wrote it down as one of kind of my formal goals. I want to experiment a little bit and release at least 10 podcast episodes during 2021. So I'm stoked to be able to say that by the time you are watching this video, the podcast has gone live. And I haven't just released one episode, I have in fact released 3 to kind of kickstart the whole thing off. The first one is sort of short, sort of 5 or 6 minute introduction to the podcast and some of the things that I'm going to be talking about over there. The second episode is a podcast I recorded with Brad Kalner, stock compounder, who many of you will probably know from YouTube. And the third podcast is sort of like a part 1 episode on my entire investing framework. I'm going through sort of start to finish of everything I look for in an investment, how I think about sizing certain positions, what I'm looking for in a company, valuation, management, margin of safety, and how to kind of save money and generate enough cash to make an investment in the first place. So there's a few things sort of covered in all of those different episodes. I'll put some links down in the description for you to go and check that out. So click on one of those links down in the description below, or simply search the Investing with Tom podcast on whichever podcast player you might be using. Now, the rest of this particular YouTube video is going to be a few kind of snippets from those first couple of episodes to give you kind of a feel for what you can expect to hear. But definitely head over and check out those few podcast episodes and let me know what you think. I do hope you enjoy it. And I really enjoyed putting those few episodes together so far and hope to do many more out into the future. So definitely check those out and let me know what you think. I'm kind of excited to see how it all goes. But with all that said, here are some previews, some kind of extracts from those first couple of podcast episodes.
The thing I want to start off with is just a very simple definition of investing. And again, like I say, I don't have too many original ideas, and this one is going to come straight from Ben Graham and The Intelligent Investor. I think particularly right now we're at a point where almost anything is getting viewed as an investment. We've got Bitcoin running wild. We've got people investing all their money in gold because they think there might be a lot of inflation with the current money printing and so on. And I really want to give you my definition of what I think an investment is. Now, an investment for me really comes straight from Ben Graham's definition in The Intelligent Investor. And basically, an investment for me is something that provides safety of principal and an adequate return. So what does that mean? Essentially, safety of principal allows us to make investments where the chances of us losing money over a long period of time are very, very slim. Now, that doesn't mean we're going to invest in stocks that never go down or anything of the sort. It really just means that we're buying into businesses where the odds are heavily stacked in our favor that we're going to come out the other side of this okay. If the price were to go down, maybe that's an opportunity for us to buy even more ownership in a business or whatever asset we're talking about here at even more attractive prices. So that's what I mean by safety of principal. An adequate return is obviously, what we're looking to get out of investing in the first place. Really what we're here to do is try and turn our existing dollars into more dollars over time. So we need to get some sort of return out of that investment. So when you combine those two things, safety of principal and an adequate return, it really narrows down the whole sort of investment and even speculation kind of universe quite a bit. So it's really going to push us towards cash producing assets. And the reason for that is because when we've got a cash producing asset, that is something that we can actually place a value on. I mean, for example, I was looking at some of the businesses that Provise bought in Turkey, for example. And if I look at the Turkish dollar or the Turkish lira, is it, I think,
lira, yeah.
versus the New Zealand dollar, it's just been, the exchange rate's just kind of gone, the purchasing power of the Turkish lira has just gone down very consistently over time. Whereas If I look at something like the US dollar, because I'm earning money in New Zealand dollars and having to constantly convert that to US dollars for a lot of my investing, although that fluctuates, it's been a lot more, it's been in sort of a tighter band over a period of time. So have you done any thinking around how you might manage something like that?
Yeah, well, I've heard Pabrai talk about that. And basically what he says is, if you have a big enough margin of safety, it's not something he thinks about too much.
Yeah.
Like I think his investment in Turkey, the warehousing REIT, it's gone up something like 10 times in a year and a half. And so if you compare that to how the currency has performed versus the US dollar, it's not going to move the needle too much when you compare it to how impressively the stock has performed. So that's kind of my thought on it. And it reminds me of, Li Lu talking about, his initial investments where he took, I think he got like a loan for school going to Columbia. And instead of using that for tuition, he invested it in like Russia or something. And, the currency was a concern, but, he found it was like $1 for 5 cents or something like that.
Yeah.
So if you can find a big enough margin, it's just, it's irrelevant, I would say.
This is a business that might not necessarily have a long runway for growth, but they might still be a really attractive business. A good example of this is actually not a public company, or at least not directly a public company. And that's a business called See's Candy, which sort of lies within Berkshire Hathaway. Now, See's Candy basically manufacture and sell boxed chocolates. They have a relatively small sort of asset base to run their business, but they print a lot of money. They produce a lot of cash flow off of that business, but the company doesn't grow. They've tried to expand into new areas. They've tried to release new products, and some of it's sort of worked here and there, but largely the business is kind of just steadily pumping out good cash flows on a relatively small set of assets, but they really can't grow. And that's a business that is probably not the ideal place to, sit back and have money just compound, because it's going to be paying its profits out to you as a dividend, and you're going to have to find somewhere else to put that money each year. Ideally, See's Candy would be able to reinvest their profits in new stores and grow the company and so on. But that doesn't necessarily mean that See's Candy is a bad business. Now, if we can buy a See's Candy, for example, at a reasonable price, that can also work out really well. Like I mentioned earlier, if you can buy a business for 50 cents on the dollar and it, goes back up to $1 on the dollar and over the next 2, 3, 4, 5, 6, 7 years even, that's still a really attractive return. And this is probably the area that I've found myself putting most of my portfolio over the past couple of years. Not necessarily out of preference for doing so. It's just I haven't been able to find the spectacular compounders, particularly recently. So that is sort of the second type of business I'll buy, is something that is still reasonable quality, but doesn't grow. Or perhaps even something that's slightly poorer quality, but it's just trading so cheaply that the maths make sense, the investment still makes sense. I think there's a margin of safety, and I think the returns look good.
Probably said all we can there.
Yeah.
Here's an interesting question for you. Would you rather buy? This is I'm shortening the question up a little bit here, but at today's prices, would you rather own Berkshire or the S&P?
I think that was my favorite question, actually. And it was like three parts to the question.
Yeah.
Oh, man. Berkshire. It's kind of easy for me, actually.
Yeah. What's the logic there?
I just think when you compare value to price, Berkshire is much more compelling than the S&P. That's kind of my short answer.
Yeah. I think a lot of people are getting caught up in the fact that, Berkshire's lagged the S&P 500 for the last decade or 15 years or whatever it is. And they kind of just dismiss it and kind of say, these 20% a year days are over, which they are. Like the law of large numbers tells us they're not going to compound at 20% for the next 50 years.
Sure.
But I mean, I think it was Tobias Carlyle that said something along the lines of, when you compare Berkshire and the S&P 500, Berkshire has a higher return on invested capital. Berkshire is growing faster. Berkshire's cheaper, and Berkshire has the best management in the game. So when you try and frame it like that as an S&P versus Berkshire, it kind of becomes a fairly clear decision in my head. So I'm on Team Berkshire also on that one.
Yeah, and I think if you want to do the very simple argument here, which is out of favor. And often the companies that are out of favor have been beaten down in price. And those tend to be the companies that outperform over the next decade or so. So I think that's a pretty easy argument one could make for Berkshire.
Yeah, and Berkshire's got some incredible businesses in there. Like,
absolutely.
If you look at something like the Berkshire Hathaway Energy or the railroad business, they're about as reliable a business as you can find anywhere. So, if you can buy Berkshire, and I'd have to look at what the price is doing at the moment, but say you're getting something close to like a 10% free cash flow yield on that at the moment on an asset that's just printing money and will print equal amounts of money probably in even large downturns. When interest rates are nearly zero, that's quite a valuable asset at the moment in my head.
Yeah. And it seems like, Howard Marks talks about this. There's really two ways to optimize a portfolio. One is, are you optimized towards, FOMO, fear of missing out? Are you optimized towards growth, or are you optimized towards not losing money? And Berkshire is clearly, always focused on the not losing money side. And in markets like this, where it's very frothy, there's been this huge run. Berkshire, I think, has probably always underperformed in that kind of market. But of course, what goes up must come down. Market cycles, the market is always cyclical. So at the end of the day, Berkshire will rise again.
I like it.
Probably sooner than later. Sooner than later.